Steve Leesman of CNBC said this yesterday, which I found worthy of using in today's video. He said, if you're not confused, you're not paying attention. Listen further to what he said.
Yeah, I mean, Deirdre, if you're not confused, you're not paying attention. I think that's the way to think about these things. The data coming in is so extreme. The Philly Fed is screaming recession. The jobs numbers are screaming a buoyant economy. The retail sales numbers look good. And then, as you point out, those debt numbers, those credit card numbers make me think that the consumer is reaching and taking risks with high interest rates in order to maintain standard of living amid inflation. So it's very hard to puzzle all this out. The best way I like to explain it is we're still in the middle of this transition from the COVID and the lockdowns and restoring the economy. And so we're going to have days like this where it's going to be recession one day and buoyant economy the next.
Later, he had a very interesting conversation with David Rosenberg of Rosenberg Research. David argued that the idea of a no landing was a nice fairy tale. If you look at the US 2-2-year spread, which reached a record low level of minus 88 basis points this week, that is certainly supporting that idea. This chart is saying that the US is still heading toward a recession. Rosenblum also pointed out that service sector inflation does not bottom until 15 months after a recession. He also argued that the New York Fed Empire Manufacturing Index saw 3-year inflation moving down to 2.7% from 3% last month. He characterized that as something that is not being paid attention to enough by the markets. Speaking of inflation, this week we saw CPI come in as expected at 0.5%. The year-on-year came in at 6.4%, still well above the 2%. But what's ahead? Well, the next 5 monthly CPIs from last year were fairly lofty at 0.7%, 1%, 0.4%, 0.9%, and 1.2%. The good news is when they leave the calculation after each successive month going forward and are replaced by a lower number, that brings the year-on-year down, but just by the substitution. Putting it another way, if we replace the 0.7% in the formula with a gain of 0.2%, that is a net reduction for the year-on-year of around 0.5%. Now, there is compounding and such, but I did the calculations, and if the inflation averaged 0.2% month on month over the next 5 months, when those numbers start to disappear, the year-on-year inflation calculation, taking into consideration what drops out, will come down from 6.4% currently to 3% for the headline number after the 5-month period. If you average 0.2% until the end of the year-on-year inflation would be 2.68%. The Fed projected 3.1% in December's central tendencies. That's getting closer to the 2% target that the Fed is looking for. That would be something to cheer about, but the Fed is not yet ready to do so. In fact, Fed's Bullard and Mester both argued for 50 basis points at the next meeting over the last week, and even the market is pushing the terminal rate higher. They see it near 5.3%, which implies an extra 25 basis point hike above the December Fed projections. Now, what would get the rate to 2% by the end of the year? If you were to average 0.13% over the next months to the end of the year, you would get the target to 1.97% to be exact, just below the 2% target. Now, what about the core CPI given the historical data and what will fall out over the next 5 months? If the average over the next 5 months were to come in at 0.2%, given what we roll off from last year, the year-on-year core would still be 4% in 5 months. Now, if the core were to average 0.2% for the rest of the year-on-year would come down to 2.85% at the end of 2023. That compares to 2.68% for the headline number and getting fairly close to the 2% target. Now, is there any further good news from the inflation front that we might be able to count on? Well, there has been a lot said about the cost of shelter. The shelter component accounts for 34.4% of the CPI. It is the largest contributor to the CPI. Because of the way the shelter is calculated, there is a lag in the impact on this CPI inflation. Basically, they survey 6 separate panels in the housing market on a rolling basis. So one panel is changed while the other 5 are not over a 6-month period. In a rising price environment in the housing market, the impact on CPI is delayed to the upside. Conversely, when the tide turns and the prices start to come down, the impact to CPI is delayed to the downside. They're only getting one panel declining at a time each month. Now, the shelter component on the CPI has not slowed, although anecdotal evidence points to a decline. In the CPI report, the year-on-year moved up to 7.91% in the last CPI report. That is still making new highs. The month-on-month gain was still a healthy 0.7%. Now, if that inflation component were to start to show the declines and average 0.3% until the end of the year-on-year for the shelter would decline to 4.62% from the current 7.91%. That would still be above the gains from the pre-current run-up in housing prices, but it takes another tailwind out of the inflation. That is the hope on inflation. However, as Leesman points out, there are so many cross-currents economically. If you're not confused, you're not paying attention, which means continued volatility in the markets and the need to pay attention to the ebbs and flows from things like the technicals. I will take a look at the technicals that are driving the markets next and sort of put things together in this weekend Forex report. With our tagline for the week, if you're not confused, you're not paying attention. The good news about technical analysis is that it'll take some of the volatility out of the market and at least give you an idea as far as the bias goes, the risk goes, the trend goes, and where certain targets will be. And so let's start taking a look at some of the major currency pairs. We'll start by taking a look at the euro versus US dollar, and I'll show you what I mean. This is the euro versus US dollar on a daily chart, and if we take a look at the different key levels in play here, what I would focus on is this area right through here. This area was defined by different swing lows, and then we turned to swing highs through here, where we had a number of different swing highs, and then a number of months later we came up and we retested that area here, and then tried to move above it here and here and here. And in the current month, what do? We moved to the upside, extended above this trend line at the start of the month, and then fell down. And what do? We started to use this swing area right between the 107.50 level and the 108.05 level as a resistance level. This was the high from last week, and you can see the high from this week came right up to that top side 108.05 level. And what do? We found sellers against the level. So the technical level did its job of holding the ceiling there, and the market started to come back to the downside. Now on the downside, we have another one of these swing areas where there's a number of different highs through here, and then we started to use it a little bit as a support here. Before rotating back to the downside and heading to our low. And when our return back up here after a few months, what do? We started to find support against this level, move to the upside. It got a little messy through here, admittedly, in this period right through here, but then reestablished, move to the upside, extending to our high. And what do? We came down to the low price here. That was our low on Friday, came right to the high of this swing area between the 105.73 and 106.15, and we closing in between this swing area up here and this swing area down here. So the technicals did their job. We found sellers against the high extreme, buyers against the top of the low extreme, and we're settling in between. So going into the new trading week, the story remains the same. If the price is able to get below this area through here, it opens up the door to the downside. It's able to get above this area right here, it opens the door to the upside. In between, you might look to sell against the extremes or buy against the top extreme, buy against the low extreme. Now, let's take a look at the hourly chart to see what kind of clues that chart is showing. And what we see off the hourly chart is a very interesting ceiling that we found both on Thursday and again on Friday. In fact, we're closing near the high for the day on Friday. But the ceiling on Thursday, what do? We came right up to the 200-hour moving average earlier in the week, admittedly, on the way to the high price that we saw against the 108.05 level. What do? We broke above the 200-hour moving average. We saw the momentum to the upside. Now, on the hourly chart, where did that momentum take us? Well, it took us right to this swing area through here. This was even a more narrow swing area near the high. Remember, the daily chart had a little bit of a wider one, but you can see, between the 107.99 and 108.5 level, that was a key level. And the market went right up to that area, ceiling on the daily chart, old floor here, and ceiling now on the hourly chart. And the market rotated back to the downside. So this failed move up here above the 200-hour moving average, the market said on this day right here, nope, we're not going to go above that level. We're going to stall against that level. And what do? We move to the downside. And lo and behold, on Friday, when the market started to move back to the upside here, where did we stall? We got to the 100-hour moving average, the lower of the two moving averages. And the market said, that's enough. Let's stall right here. Let's see what next week brings. And so that's how we're going to trade it this week. We're going to use these two levels as our barometer. If the price can remain below, it's more bearish. We look toward this swing area down here between the 106.63 and 106.68 as their next first target. And then we look down to our low price at 106.12 again, or 12. That's near the high of that daily topside target. On the top side, if we were able to move above the 200-hour moving average, again, that was the high right here, we would open up and look toward a move above that old high from Thursday's trade, and then move up toward our 60 to 75 area up through here, swing area, and then move up toward our 108.05 level. Again, another target level from all these lows and through highs that we saw here. So that's how we see the euro versus US dollar. It's pretty plain and simple, and we'll see how it all pans out. But the 100 and 200 will be the barometers for that currency pair. Let's take a look at the dollar versus yen. If I were to shade this area through here, we can see there is a number of different swing levels in this area right through here, where the market either found resistance or found support going back in time. Through here, found support against it through here, found resistance against it through here, and support against it through here, and then rotated to the upside. Came back down to that area right through here, and used it as resistance here. You get the point. And on Friday's trade, the last hour, or on Friday's trade, the market moved above that area at 134.51. That should have led to more upside momentum, but it didn't. What did? We fell back down below the 134.51 level into the swing area between 133.61 and 134.51 in the new trading week. If the market is able to extend back above the 51 level, I'd look for higher prices here with potentially a move toward our 200-day moving average, toward the 38.2% retracement of the move down from this high right up through here to this low down here. That would be the target on the break of the 134.51 if we're able to stay above that level. Conversely, if we move back below the 133.61 level, I would expect to see further selling pressure. That's the bias defining levels for the dollar versus yen off the daily chart. Now let's take a look at the hourly chart. Actually, we'll look at the 4-hour chart first and see what that has to say. And what we see on the 4-hour chart is that the price action last week came in up to and tested this trend line here. This is the week's trading range. You can see it's up to the upside here as we saw dollar buying in the dollar versus yen. A number of different points on that top side trend line that pushed the price to the downside. And then we broke above the level during Friday's trade, and we should have gone higher, but we didn't. The market started to rotate back to the downside. This area right here, this yellow area, as you can see, is also home to a number of different swing levels, which was a key, and another key failure on the break to the upside. You can see the number of different swing lows and then swing highs through here, where the market stalled or either found support or found resistance. And in the break to the upside that we saw on Friday, should have extended higher, didn't, failed on the break of the trend line, failed on the break of this swing area, moving back to the downside. So from a technical perspective off of this 4-hour chart, what are we going to look for? We're going to look for resistance against this area now. The buyers had their shot. They couldn't do it. They started to rotate back to the downside. So watch early on if we move up toward the 134.49 level, if we're able to keep a lid against that area and push the price back to the downside. If we're able to do that, then I would think that we would see a rotation back to the downside, back below the 61.8% retracement of 133.98, and see if we can correct lower here in the dollar versus yen. If we can't do that, get below the 61.8% retracement, and perhaps move below these low levels, all bets are off. After all the buyers are trying to make a play, they made a play all during the week. We just failed up here, so we're just taking the last failure up here as sort of our guiding light. Stay below 134.49 is going to be our key level in the start of the new week. We'll see how all that pans. All right, let's take a look at the sterling versus U.S. dollar. And again, we'll start off on the daily chart. And if we look at this daily chart, what did we do on Friday? We came down and we moved back into the below the 200-day moving average, and but above the 100-day moving average. 200 comes in at 1.1940. The 100 comes in at 1.1892. So it was about 50 pips in between each of those moving averages, and you can see the price moved down in between that level and then bounced higher. And we closed the sterling versus U.S. dollar up at 120.40 area. So a good ways away from the 200-day moving average. So nice bounce off that area. That gives the buyers a little bit more of a bias advantage going into the new trading week. Let's take a look at the hourly chart and see what that is doing as well. The failure below the 200 and the failure to get to the 100-hour moving average led to this rotation to the upside. If we put a Fibonacci retracement on the move down from the high price that we saw last week to the low price we saw on Friday, the 38.2% retracement was tested right near the close, and the market did find some willing sellers against that level. Not surprising, just stall out. We'll see how it all plays out. Sort of the barometer for the one of the barometers for the new trading week. The other barometer for the new trading week will be this combination 100 and 200-hour moving averages. Those come in at 120.64, 120.74. So in addition to the 38.2% retracement, that's right here, we have on the top side the 100 and the 200-hour moving average to get to and through. If the price is able to get through those levels, that increases the bullish bias for this pair, and we should see further upside momentum. Conversely, if we do rotate up toward those moving averages or can't get above the 38.2% retracement, and we find sellers against those levels, then guess what? The sellers are more in control. So key levels through here at 100, 200, and then the 38.2% retracement. On the downside, we'll watch this level right through here as an interim support level for the sterling versus U.S. dollar. This level has, again, a number of different swing levels in play. And what I like about it, on Friday, the market moved above this level, came back down, and where do we find support? Right at the 119.91 level, and the market rotated to the upside. So the buyers remained in control. That's where we have the control in the short term, but we have work to do on the top side. But watch the around the 120 level down to 119.91. If the market is able to get below those levels, that opens the door for further selling. All those levels are in play. We'll be paying attention to them. Let's take a look at the dollar versus Swiss franc next. And if we take a look at the daily chart, we had a rotation to the upside here. Lots of up and down volatility through here. What we know from our earlier reports on this currency pair is that this break earlier in the month to the downside here, where we had a number of different swing lows through here. This was a pretty solid floor here, wasn't it? A number of different swing lows through here before the market rotated the downside. And what did we do in the month of January? Came right down to the level bounce. And in the month of early February, we moved below that level, couldn't sustain the momentum, and bounced to the upside. Admittedly, we're seeing lots of up and down volatility here, but we did move to new February highs on Friday on the dollar buying. We saw the market rotate to the upside, only to fail and move back below that level, currently trading at 0.92389. So bit of a failure up there. and we're seeing a rotation back to the downside in the dollar versus Swiss. We need to get above the 92.87 level in order to push this price further to the upside. If we can't do that, it's going lower. Now let's take a look at the hourly chart on the dollar versus Swiss, and we'll see if we can make some sense in regard to it and our expectations. And if we look at this ceiling area through here, it goes back further in time, but number of different points through here. And again, there's other levels back here in this area here. What do we do? On Friday, we moved above that level. We should have extended higher, and we did. And then we tried to hold support through here on the break to the upside, but we couldn't, and the market fell back below this level, and we saw the selling into the close. Now, the selling into the close did come down to those key moving averages once again, the 200 and 100 hour moving averages. This case for the dollar versus Swiss, the 100 is at around the 0.9235 level. The 200 is at 0.9225. So about 10 pips separating those two, and you can see we got down toward the 38 level or so thereabouts into the close. And that's going to be the two moving averages are going to be our barometers in the new trading week. As long as the price if the price is able to stay above that, that's going to be more bullish. If the price moves below those levels, however, that's going to be more bearish for the dollar versus Swiss. So again, pretty clear from a technical perspective on the top side. If the market should rally to the upside, we need to get above the swing area. We're at a number of different levels: 92.78, 92.90. That's going to be our key target on the top side. On the downside, break below the 100, 200. We'll look for the 61.8% retracement, and then look further down. This is a nice little floor down here, by the way, between the 0.9157 level and 0.9165. Again, you can just earmark and see a lot of different swing lows through here. Nice little floor. Got a little messy through here, admittedly. Just tried to hold resistance through here. Couldn't, and then broke to the upside, and then came back down to this level and failed in trading on the downside last week to our lows, but then reestablished support, moved to the upside. So this area is key level on the downside for the dollar versus Swiss on further selling pressure. Take a look at the dollar versus Canada next, and on a daily chart, we're ping-ponging or staying above the 200-day moving average and below the 100-day moving average. Admittedly, on Friday, we did move above this trend line. This trend line connected a number of different spots along here. We did move above it briefly, and also above the 100-day moving average. What should have that done? That should have sent the price further to the upside. Didn't. Market rotated back to the downside as a result, and we're closing below the prior highs from February, kind of tilting the bias back to the downside here, below that those previous highs, below the 100-day moving average. Let's take a look at the hourly chart next, and if we put that chart on, I'm going to put it on the hourly chart. What do we see here? The failure above the 100-day moving average and above this swing area through here. I'm going to put it to the 4-hour chart. This is a clear picture on the 4-hour chart of the ups and downs. This area right through here, swing levels, swing highs, swing lows. Swing highs right through here, broke above it, failed, started to rotate back to the downside. Now, this other area right through here, where we have a number of different swing highs, most recently over the last few weeks, you can see that we had a failed break right here, and then broke above that level and stayed above the level. And as you can see in Friday's trading, in the last hour of trading, the market came, or the last 4 hours of trading, the market came down to this area and rotated a little bit to the downside. 134.67. If we get below that level, opens a door for the 38.2% retracement of the range coming from that high back then. If we are able to hold support here, we're going to start look back toward the 100-day moving average, start look toward the this area right through here. But 100-day moving average is going to be key at 135.17. Get above that level, opens the door for further upside. On the downside, the 200-hour moving average also in play at the 134.05. And the 100-hour moving average also in play on the downside. Lots of ups and downs in the dollar versus Canada. We tried to make a break to the upside. It seems like it's going to fail, but we'll be watching this area here in the early week to see what happens right here. Do we go higher, or do we rotate back to the downside in the dollar versus Canada? Let's take a look at the Aussie versus US dollar next. And if we look at this on the daily chart, what did we do on Friday? Came right down to the 200-day moving average. And what do? We found support against that level right through here. That's going to be our key barometer in the new trading week. On the downside, if the price can move below that 200-day moving average, that would be more bearish for this pair. If the market stays above it, it's more bullish. Now on the top side, we did run into some resistance at the high of this swing area on the daily chart. You can see this right here comes in at 0.6892. So getting above 0.6892 in the early part of the week. And then the 0.6915 level, which is a 50% retracement of the range from the high in 2022 to the low of 2022. That's still going to be a key barometer for buyers and sellers. If you get above both the 68.92 and the 0.6915 level, that would be more bullish on the upside. Clearly on the downside, break below the 200-day moving average on the daily chart would be more bearish. Let's take a look at the hourly chart. And what we saw off the hourly chart, here's how close it got to the daily the 200-day moving average. We saw the rotation to the upside. Now, that move to the upside was able to get above most recent lows through here. Well, let's go back to this low right here and this low right here, and then these lows through here. Very quick breaks back or two and bounces back to the upside through here. In trading on Friday, the market was able to get above these area right through here between 0.6854, 0.6870. Now, there is work to do on the top side if this price is going to continue to go higher, including getting above the 100 and 200, getting above the 38.2% retracement. Needs to get above all three of those levels in order to push this price to the upside in the Aussie versus US dollar. If it can't get above those levels, guess what? This is just a correction in what is more of a bearish bias, but watch these levels through here as well, down through from the 0.6870, 0.68549 level. Get below those levels, opens the door for the downside for the Aussie versus US dollar. Finally, the New Zealand versus US dollar in the daily chart. Very similar to what we saw in the Aussie versus US dollar. The price came down on Friday and tested its 200-day moving average. That's the green line in this chart right here, and bounced off of that level. On the top side, we do have the 50% of the 2022 trading range. The high right here, the low right down here. 50% comes in at 0.682719. Get above that level. It was also a low earlier in the month right through here. So get above the 0.62719 level, be more bullish for the New Zealand versus US dollar early in the week. And then we look toward this target area up here between the 0.6363 and 0.6394 as our next target. Those were high prices through here. If it's able to get above those levels, that would open the door for further upside potential in the New Zealand versus US dollar. Now, on the downside or if we take a look at the hourly chart in this currency pair, very similar to what we saw in the Aussie versus US dollar. Yes, we bounced off of the 200-day moving average down here, but we still have work to do on the top side. In particular, if we were to move higher, I'm going to put a Fibonacci retracement from this high down to, oops, wrong one. All right, here's our Fibonacci retracement from this high right through here to this low through here. And I'm going to take out this one right here. But if you look at it, the 38.2% retracement is very similar to this low through here. In fact, it's right on top of it for the most part. 0.6267, these lows through here, coming around that level, and the 38.2% retracement of the last move to the downside, which happened to be also a double top through here from last week and this week's highs, near the 0.6388 level. So get above the 38.2% retracement, then we'll start to look toward the 100-hour moving average and the 200-hour moving average, blue and green lines, and that opens the door for further upside momentum in the New Zealand versus US dollar. That's how I see it. So if you're not confused, you're not paying attention, but if you're paying attention to the technicals, some of that confusion gets thrown out the window. You just have to pay attention to those key levels. I hope you found this video useful. My name is Greg Michalowski. Good fortune with your trading. Bye-bye now.